For the last 50 years, your financial life was locked in a digital basement. The bank owned your transaction history, your credit score, and your identity. But in 2026, the walls of that basement are coming down. We are entering the era of open finance, and it is moving the vault directly from the bank's basement into the customer's pocket. If you work in IT, whether you are a backend developer, cloud engineer, or an architect, this is the single biggest architectural shift in the market right now. We aren't just building standalone apps anymore. We are building the highly secure bridges that let users take their data wherever they want. Today, I'm going to break down exactly what open finance is, the two core API requests that run the entire system, and how to build it securely. Welcome back. I'm Gokul and I spend my days building enterprise grade systems here in the Middle East. Today we are tearing down some of the buzzwords. We are going to look at the what, how, who, and the operational reality of open finance. My goal is, by the end of this video, anyone working in tech will understand exactly how the future of money works behind the scenes. Let's start by defining the battlefield and looking at how the data actually moves. To understand open finance, you first have to understand what it is replacing. A few years ago, the industry introduced open banking. That was a massive step forward, but it was limited. It basically meant a customer could let a third-party budgeting app look at their checking account balance. Open finance is the evolution. It's an API-first ecosystem where the bank explicitly does not own your data. You do. Open finance expands the scope to include your insurance policies, your mortgages, your investment portfolios, and your corporate accounts. From an engineering standpoint, every single open finance interaction boils down to just two primary types of API request. If you understand these two concepts, you understand the engine of modern fintech. The first is AIS, Account Information Services. This is the enquiry or read-only request. Imagine a user wanting to buy a house. In the old world, they had to print out bank statement, call their insurance broker, and email PDF files to a mortgage lender. It took multiple weeks. In the open finance world, using AIS, the user opens the lending app and clicks connect. Instantly, the lender's API pulls real-time data read-only from the user's checking account, their stock portfolio, and their salary deposits. The risk engine approves the mortgage in just 3 seconds. Another massive AIS use case is corporate accounting. CFOs using API to pull global balances into one live dashboard every morning instead of downloading multiple spreadsheets. But AIS is only half the story. The real disruption is the second type of request, PIS, Payment Initiation Services. This is the action or the right request. Right now, when you buy something online, the merchant uses a credit card network to pull the money from your account, and those networks charge heavy processing fees. PIS bypasses the card networks entirely. With PIS, the merchant's app talks directly to your bank API. You click buy and the bank app opens for a biometric face scan, and the money moves instantly from your bank account to the merchant's bank account. Zero credit card fee, instant settlement. But here is the technical reality. Data is a liability. When you start allowing third-party apps to read investment data and initiate live payments, the attack surface of your system expands massively. You are punching holes in your own corporate firewall on purpose. So, how do we open the vault without letting the robbers inside? When we talk about opening up financial data at this scale, standard REST APIs are not enough. We have to use a globally recognized standard called FAPI, the Financial Grade API. If you build a standard API for a banking system, you are asking for a cyber disaster. A regular API is like a traditional house key. If someone else steals, they can also unlock it through your front door and walk right in. But in Open Finance, we use FAPI, Financial Grade APIs. This isn't a house key, it's a biometric thumbprint scanner combined with a time-sensitive passcode. It is the highest level of API security that currently exists. It forces mutual authentication, meaning the bank and the third-party app have to cryptographically prove exactly who they are to each other before a single byte of data is shared or a single payment is initiated. If your team is building fintech integrations, FAPI compliance and Mutual TLS aren't just nice to have, they are the absolute baseline for survival in the modern financial ecosystem. Now let's go a layer deeper. Underneath FAPI, we rely on protocols like OAuth 2.0, OpenID Connect, OIDC. But FAPI tightens the rules drastically. For example, FAPI requires something called MTLS, Mutual Transport Layer Security. In a normal web request, your browser verifies the server. In MTLS, the server also verifies the client using cryptographic certificates. Furthermore, FAPI mandates the use of digitally signed tokens. We don't just pass a token that says user 123 is allowed. We pass a token that is cryptographically sealed, proving that it hasn't been tampered with in transit. Your API gateway must enforce these FAPI rules. If a PIS request comes in, your gateway must intercept it, validate the MTLS certificate, verify the digital signature, and check the limits of the token. But even with perfect security, there is one component that is even harder to build. The hardest part of Open Finance isn't moving the data. Moving JSON payloads from server A to server B is a solved problem. The hardest part is managing consent. In this ecosystem, the user is the absolute boss. They are the who that dictates exactly what happens and for how long. The entire IT team has to rally around building a highly available, deeply complex consent management system. So, moving data is easy. Revoking access is the real engineering nightmare. In Open Finance, the most critical component a tech team will build is the consent management engine. When a user tells their bank, let this budgeting app see my transaction for the next 90 days, you have to store that exact rule. But what happens on day 14 when the user changes their mind and hits revoke? Your system must instantly invalidate the tokens, sever the API connection, and ensure that the third-party app cannot pull a single extra byte of data. It's not just about granting access, it's about absolute real-time control. If your system doesn't allow a user to revoke access just as easily as they gave it, you have failed the core philosophy of Open Finance. The user is the boss. We are just the custodians. Now, let's break down the technical workflow of consent. When a user wants to connect to a new app, they are redirected to their bank authorization page. The bank says, app XYZ wants to see your checking account for 6 months. Do you agree? If the user clicks yes, the system generates a specific consent ID and maps it to the OAuth token. Every single time that the third-party app requests data, your API gateway must call the consent database and ask, is this consent ID still active? Has the user revoked it? Has it expired? This means your consent database is going to be hammered with a lot of traffic. It needs to be incredibly fast and highly available. Teams often choose distributed in-memory data stores like Redis to handle these lightning-fast consent lookups, backed by a persistent database for audit trails. Building this is one thing, but running it is another. Let's talk about the operational reality, what we call day 2. Once your Open Finance APIs are live, you aren't just dealing with internal traffic anymore. You are dealing with hundreds of external third-party providers. This requires heavy focus on rate limiting and throttling. If a fintech app has a bug in their code and starts pinging your AIS endpoint 10,000 times a second, your API gateway needs to throttle them instantly without bringing down the core banking system. Furthermore, we have to master webhooks and event-driven architecture (EDA). In a PIS flow, a payment might be initiated, but it takes a few seconds to clear. So the third-party app doesn't want to sit there and poll your API every second asking, is it done yet? Instead, your system needs to fire a secure webhook back to them saying payment is successful. Operating an open finance platform requires world-class observability. Because the payloads are encrypted and digitally signed, debugging a failed request requires specialized logging that protects the customer's privacy while giving the engineers enough data to fix the issue. So, why is this exploding right now? Why are entire IT departments pivoting to focus on this? It's because of top-down regulation, and the Middle East is rapidly becoming the epicenter of this great revolution. Across the Middle East, regulators are rolling out comprehensive open banking and open finance frameworks. This isn't just a gentle suggestion or a tech trend. It's a strict regulatory mandate to modernize. Every major financial institution is currently racing to build secure, compliant API bridges to allow fintechs to connect to their legacy cores. They need IT teams who deeply understand FAPI, consent management, and the difference between AIS and PIS flows. So the regulators have paved the highway, and now the entire financial sector is executing the vision. We are taking monolithic legacy systems that were built decades ago and securely exposing them to the modern lightning-fast world of mobile fintech. Let's recap the open finance architecture. It starts with the philosophy the vault is in the customer's pocket. It runs on two primary engines, AIS for inquiry and PIS for payments. It relies on absolute security of FAPI and MTLS. It is governed by a strict real-time consent management layer, and it is being driven forward by aggressive forward-thinking regulators right here in the region. If you have any questions about AIS, PIS, or how FAPI works under the hood, drop your question in the comments below and I will jump into answer.